Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we had a busy week, a volatile one, especially in the markets. Hopefully everyone has a fun weekend plan. Mine is taking my daughters to the sweetheart dance. So we're going to have father-daughter dance, getting a haircut, and then I'm off to Calgary. So for anyone who's in Calgary and then in Toronto, please let me know. I'll be there for several days. But with that being said, we now want to turn to the Primary Vision Frac Spread Count. So for those that have been watching us, we've been talking about how May was going to be more of a bigger month, and we had an increase of 6. So we went from 278 to 284 with the view that we were going to get to about 290 by the end of this month, and then another 8 to 10 throughout June, because we were going to see this bigger push as we normally do, really, when we look at the seasonality of it as we go into the summer months. So when you look at the Permian added a bit of capacity, but we're just going back to where we were. Because remember, there was a little bit of a slowdown. Now we just have some of that coming back. But the bigger shift was in the Western Gulf region, which is something we've been talking about, where when we look at the Western Gulf, we want to look at what is happening within the Eagle Ford, within Eastern Texas, and then at the same time in Louisiana, and just in that general area. And we've seen the increase in DUCs in the Haynesville, as we showed, where DUCs were actually not even just stopped going down, but actually started to increase. And we're going to see that bigger push as we see some of this activity pick back up. Some of the smaller basins also picked up some activity. So again, we're right on track to be where we think we're going to be at about 290 as we exit the month. But then when you look at rigs in general, so the rigs we had we added 9, 6 in oil, 3 in gas. But then when you look at what was added, you had another 5 in the horizontal side, another 4 in directional. And one of the things that we've been talking about is the Anadarko and really the Mid-Con. And when you look at Oklahoma was a big driver of the additional rigs. And that's something that we think is going to continue, is when we look at where do we have the most opportunity, it remains in that liquids as well as gas, obviously crude as well. But when you look at gas right now, especially when you look at natural gas, and we have the curve, we had a request to show the natural gas curve as we show the oil curve in the EIA show. So we just wanted to show where things are, where the payback period is, and why it's really going to support some of this activity, especially as we go, given where crude prices are, natural gas, but also the global market. But we also have to consider where's cost, because we're going to have to cover this extensive cost. And we wanted to show that the North American Steel OCTG pipe went up again. So we continue to see an increase in pipe pricing, in steel prices, which for those that are following the raw material side of this, it's not that surprising. We don't see this getting any better. But realistically, as we've been saying, it's going to have these step change moves, but still remain at all-time highs. But it's obviously not just the equipment, not just the supply chain, but it's also the cost of employees. And this is one where we look at the employment cost index went up 1.4% quarter over quarter versus the estimate of 1.1%. And this was just pulled out from the Econ show, because if you look at the oil and gas space, there's no difference. You're still going to see this cost. You're still going to see this increase in labor price. And if anything, it could even be a little bit more on or I should say it is more on the OFS side, just because there's a certain amount of risk. There's a lot of training. There's a lot of hours, odd hours, depending on the shift that you're on. So that's going to demand a premium, and especially to come back to what we have seen to be a very volatile market, especially for the labor side. And that's for those that have been unemployed or laid off over, how many times over the last 8 years. You get an idea of why you have some of this increase. But if it's happening throughout the whole country, it's also going to get impacted even more in our sector. So then when you look at natural gas futures, I think it's important to look at where the big shifts have been. And you can see from 3 months ago, there's been a big step change up. And obviously, Russia plays into that when you look at the uncertainties of how much natural gas is going to go from Russia into Europe, and how is Europe going to essentially change or shift some of those flows. So in the near term, you can see that we're above $7 essentially to about June to about the end of this year, beginning of next year, and then you have that step change down. But no matter what, you're still between this $4 to $5. And if you think back to where we were, I mean, even 3 months ago, where $3 was a gift, before that, there was always this perpetual 325, 275, 325 was kind of this level. But now, here we are with the step change higher to $4 to $5, making a lot of these dry gas regions, wet gas regions, very profitable. And that's pulling in some of this additional activity that we've continued to see but more importantly, in the Haynesville, in the southern part of Oklahoma that has a lot of dry gas, and then again in the eastern Texas region. So there's a lot of support for where things are, even if we get this big step change. I mean, everybody would have been begging for $4 last year, and here we are. That's actually the low end of the curve. So here's where you're going to continue to see this movement. LNG flows are going to continue to support that. Local consumption, same as well. Now, when we start looking at where things are, because we had this back and forth on Twitter, looking at what is happening with world stocks, how are shifts moving on the food side. And I think this is really good of world wheat stocks to use. And you can see going back to, really since 2013, 2014, you can see that step change down where you're continuing to see a little bit of this degradation in general. And one of the things, when you look at yields going back to the 30s, we've had a huge step change higher. I mean, it's essentially been a 45-degree angle since the late 1930s, really, or early 1940s, and it's better understanding of chemicals and farming and equipment, and a lot of things have come into play. But when you look at the last 10 years, and again, there's been obviously good years and bad years, but holistically looking, we've seen a bit of this flatlining, and that's becoming a bigger problem, especially because as you flatline, because the world population hasn't slowed, and so the population's going up. You're seeing a cap in some of this, and now not only are you seeing a cap in yield, but you're also getting droughts. You're getting, now you have the geopolitical shifts. You're getting floods. So you're getting these extremes, which is really impacting things. So when you look at wheat pricing, could remain elevated well into 2023. The USDA pegs world wheat stocks to use, excluding China, at 14.9% for 22-23, the fourth lowest ever and the lowest since 07-08. And then the 14.3% all-time low, that would be down from 16.4% in 2021-2022. So then when you look at WASDE and you look at some of the different shifts that we've seen in ending stocks, corn is essentially had a little bit of a better number. Soybeans, right in line. But then when you look at wheat, soybeans and wheat had the bigger drop in the U.S. And then when you look at world ending stocks, corn has and soybeans have been fairly stable. But then obviously you had that big drop in wheat. Now, if you have a smaller increase in one of the others, then that'll be good. But if you have a sizable drop in something else, you have to replace it with something. You're not going to sit there and be like, well, I can't eat wheat today, so I'm not going to eat. No, you're going to go out and buy something else. So that's why you have to look at how they're going to move together, where that replacement cost is. So global wheat stockpiles will decline to a 6-year low, with Russia's invasion of Ukraine snarling exports out of the Black Sea. Not that that's surprising. The USDA typically doesn't make cuts to its corn yield model during May when crops are still being planted. But government economists said that the slow pace of planting was raising the risk of yields falling short, and it made a cut to its estimate and brought production lower than anticipated. Ukraine exports seeing a massive drop. Others are stepping into the foray, including India, but more exports out of India will cut wheat stockpiles there to a 5-year low, just as local officials were raising alarms about food inflation. So as we showed in the Econ show, food inflation in general in India had a big spike, but yet their ability to export is going to be limited, especially given how low they already are on stockpiles and how there's a continuation of drought problems in the country. Some of that is starting to abate based on the recent weather forecast. But again, these are things that are going to be a perpetual problem in the underlying market. And that's also leading to what we've been talking about, especially in the US, on that sticky versus flexible inflation. And we've been harping on this where sticky inflation was going to become a bigger and bigger driver of the inflation number as flexible started to pare back. And that the issue with that is that doesn't go away quickly. That gives way to why we've been saying that this transitory trend or view was really outside of what we were actually seeing, and the sticky inflation continues to grind higher. And as we showed in this past week's econ show, there's more behind it. There's going to be more pressure to the stickiness, especially when you look at rent, when you look at food, when you look at some of these underlying pieces, and obviously food falls under the flexible. But the underlying input cost that diesel brings to general supply chains and everything else, those are the problems that are continuing to hit the system. All the same time, as we showed in the econ show, the real wages continue to fall, and then discretionary spending continues to shift lower, which again is going to impact how people are going to react and how spending is going to be adjusted. The CPI durable goods ex used vehicles and the S&P manufacturing PMI, you get an idea of where durable good prices, excluding used vehicles, are, where output prices should be. So you should see some of this coming down. But there's that competition of how much do they come down, because the consumer goods potential is starting to roll over just because you're looking at just where are people spending. You know, if people aren't spending as much, then you should see that demand pressure. The issue is supply, because that's when you start looking at China, when you start looking at the supply chain, where theoretically, you should start to see some of these hits, but that's where we come to that stagflation piece, where you have the wages coming through, the logistics problems, the supply side starting to become an issue again, even as the demand starts to soften. Now, when you look at the pace or inflation's, the breadth of inflation, you can see that there is over 61% of the categories that make up CPI are over 5% increasing. And that's why the breadth of what is driving inflation continues to grow, which is why, again, giving more credence to the stickiness behind that, where we see things going, and the pressure that's going to remain across that whole situation. All the while, U.S. real average earnings continue to weaken. So as those prices go up, that's why you see that demand side, but the supply side is going to make that a bit stickier. And then when you start looking at, we talked briefly about China, and we did a bigger show on segment 5, but it's important to look at China in general, because they've come through and saved the world before in terms of stimulus. But when you look at the support that has to happen, you can look at the local governments and how they're going to try to boost land sales, because as we've said over the last several years, land sales are so important for local government revenue, and they've been cutting taxes, they've been cutting different tariffs and fees. So, and then you have unemployment that has been increasing. So local governments are struggling to finance themselves as they've been asked to do more, while one of their biggest revenue generators, land, is not being able, or is seeing this big decline. So again, a lot of this is becoming this longer term problem, this longer term issue when you look at stimulus and how quickly they can try to right that ship and really try to push things forward. And if they can't do it, again, more pressure on diesel, more pressure on crude demand, more pressure in general on some of these industrials components. Now, in our insights today, we talked a lot about diesel because we wanted to show the difference between Pad 1, Pad 3, where that shift is. And the Colonial Pipeline is now sold out on Line 2, which is the main disti movement from the Gulf of Mexico into Pad 1. We've had about 2 million barrels a day 2 million barrels that's going to be coming into the market, into Pad 1 from several different locations, including Greece and the Middle East. And then we also have that pivot of how much gasoline's in the market and when is that going to start to pivot, because Pad 3 still has a near record amount. The Pad 3 has the same amount of gasoline in it as it did in 2021. Only time it was higher was 2020. And then when you look at Europe has a record amount of gasoline in it. So again, there's going to be some of this movement, and we expect some of that gasoline to show up on Pad 1. So that's what we have for you today. We'll do a deeper dive next week. Unfortunately, I will be in Canada, so we won't have the EIA show and the Econ show, but we will have the FSC show. And then after the week after, we'll be back to our normal schedule, and my travel schedule calms down, so we should be hitting things, hit the ground running on both the EIA and Econ being back in action. So we hope you have a great weekend, and thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.